In today's video, we are going to answer the question, can I actually, or can I really pay 10 times my base premium into PUAs per year? You show me that on an illustration, but is it actually possible? Let's have some fun. So we do receive this question on occasion. Will the company, the insurance company that I'm looking at, actually allow me to pay 10x my base premium? And my answer is yes. We have a lot of people that do that. We've been doing it for years. However, if you like to see actual data, actual proof from the insurance company and see things in writing, I am 100% with you on that because I like to see things validated in writing before I do anything. So to add some more context to this question, what we often get is a case like this, where someone will say, okay, I see an illustration, numbers look fantastic. Thank you for showing that, Steve. I want to pay in $50K per year. My base premium is $5,000. Can I actually do it though? What you show me on the illustration, I've heard that I might not be able to do it, and I would just like that validation before I commit a significant dollar amount per year toward this policy. Whether it's $50,000 per year, maybe it's $5,000 per year, maybe it's $500,000 per year, whatever the dollar amount is, can I actually do what is illustrated? In this particular case, 10x my base premium. And the answer is yes. So just to provide some visuals to this particular case, here's what sometimes comes up. Here's a policy, 40-year-old male, funding a policy at $50,000 per year for 10 years. What we have is as follows. Here's our base premium at $5,000. We've got a paid up additions rider here at $45,000. It's technically a little bit less because a small portion of that comes out to satisfy the term insurance rider. But we have this very, very close to maximized for cash value upfront, long term, break even year 5, looks great. Okay. So the specific question we get sometimes is, can I actually do this? Because when I look at this illustration, so what I want to mention here, just going back to the whiteboard, is there is a difference between what is in my illustration with respect to language and then what is in my formal contract. So we've got specific PUA language. All companies have different rules and regulations on this, but we've got what is in the illustration and then what is in my formal contract. And what I'll add is different riders that you attach to a whole life insurance policy will have a huge impact on your ability to pay in more or less money toward PUAs on an annual basis. So going back to this example, let's look at the illustration first. This is a full illustration. Let's go to page 3, and here's what I want to touch on. So this piece is sometimes pointed out from people we work with. They're looking at the policy and they say, okay, you showed me 10x. However, if we look at this particular company here, when I look at this guy, I see that it reads, the illustration shows one or more PUA payments after year 1. So this is Guardian. They allow you to pay 50x the base premium in year 1. That's why it reads after. But then after year 1, that exceed a specified multiple of the base policy premium. The multiple is 3 times the base policy premium in years 2 through 10, and 1 times the base policy premium in years 11 and later. And then we see really here, the scary part, payments in excess of this limit are subject to approval. One of the conditions may be that the insured provides satisfactory evidence of insurability, which could involve a new medical exam, the company ordering medical records. It's a pain. So why this is stating this is because we have a $5,000 base premium, and here we have PUA payments of $45,000, which, if we're going just through year 10 in this particular example, 3x would be what? $15,000, which means that could be scheduled or unscheduled, as Guardian is very flexible. We just ran it scheduled in this illustration, quick and easy to do. So we may see that and think, okay, I cannot pay 10x the base premium, and here it is in writing from the insurance company. The thing is, this is an illustration. Being aware of the formal contract and what's in there is very, very important. Now, formal contracts are sometimes north of 100 pages long. It's a lot of information. And you might think, hey, I don't want to have to read all of that. It puts me to sleep at nighttime. Can you just give me the highlights or the quick notes? So we're going to look at the quick notes here, not the quick notes. We're going to go through a formal contract. We're going to go through mine actually, just because I can show mine without any issues, just from a compliance standpoint. Illustration, we just looked at that. We'll look at a formal contract, and specifically what I want to look for here is there any language that specifies that I can exceed the limit I just saw? 3x the base premium, can I pay up to 10x? And this is one example with Guardian here. All companies have different rules and such, but this will give you some transparency when it comes to contract language and what you can and cannot do. So a formal contract will help, as you'll see language in there, language regarding what you can and cannot do. Company memos are extremely helpful. Company literature is extremely helpful as well. Material from the life insurance company. Here's a big one, very easy to do. Ask someone doing it. Do you have a policy? Have you worked with so-and-so? And have you actually been able to pay 10x your base premium on a consistent basis? Or were you shown an illustration and then you weren't able to do it? Or were you shown an illustration, you were told you can do one thing, and then you have to retract, you have to pull back on your PUA payments for some reason that came out of the blue that you weren't educated on up front. But here's the easy one, ask someone doing it. Or you can ask an agent. However, here's my opinion on that. Make sure that the agent truly shows everything, not just partial data. For example, what I had just pulled up, that illustration. We've run into cases before where we were in competitive cases. Someone was looking at Guardian, and then that illustration was shown, highlighting page 3. The client was led to believe you can only pay 3x your base premium. You cannot pay 10x. The company will not or may not continue to allow you to make those payments being 10x the base premium. The thing is, that's partial data. The formal contract states everything and it states the truth. So let's take a look here. We'll look at my policy here, one of them. So I've got 2 of them. This is based on the old guaranteed rate of 4% and then an updated one just because the PUA fees and contract language has been updated a little bit. So I'll look at a more recent policy as well. So a lot of data here, but let me hit on this point first. So if we scroll a couple pages down, here we go to page 3. This will give you information that is consistent with what we just saw in the illustration. Different numbers, but you'll see what I mean. So when we look at the premium here, we have as follows. Here's the annual premium. This is the base premium. Policy through year 64, when I'd be the age of 94 years old or 95 years old at that point in time. I started this policy at age 31. So I've got an initial scheduled PUA payment. So it's set up where I'm committed just to the minimum and I make additional PUAs on an unscheduled basis. However, check this out. Years 1 through 10, I see the PUA limits here. So after issue, this is after I've started, the following are the total annual PUA limits for all riders attached to this policy that provide purchase of paid up additions. $44,235. Take the base premium, the $14,745, multiply it by 3, and guess what you get? There you go, $44,235. So here it is in the contract specifying that I can only pay an additional 3x the base premium into PUAs. Am I limited there? Or if you have a policy, will you be limited there? So let's continue on here. What I want to do, before I zip down to the part where I want to go, you'll catch a couple footnotes here. So the target face amount is the face amount associated with 1-year term insurance with target face amount rider attached to this policy. See the rider form for details on this benefit. So it's important to be aware of this. When it comes to the 1-year term insurance rider, this is the key. You're going to see this as we continue to progress through this contract that opens up the PUA rider or opens up the flexibility, call it limits, so you can pour more money into PUAs. Let's take a look here. So if we go down, this is an older contract. It is somewhere around page 40. I will be able to tell. There we go. Because we highlighted it. That's how. So paid up additional whole life insurance rider. This is your PUA rider. Provisions within the actual contract that state what we can and cannot do. So this company allows for a scheduled and an unscheduled PUA rider. Here we go. Gives you a lot of language here, which is great. Perhaps one day we'll sit down and read the contract language together. Minimum PUA payment. So this was back in the day. They've updated it since. The minimum PUA payment had to be at least $100 per year. Meaning as long as I make a scheduled PUA payment of $100 per year, that keeps the unscheduled PUA rider open, where I can throw funds in on an unscheduled basis at discretion. But maximum PUA payment limit, here we go. And look what's highlighted in yellow. If in any given year, the total of all PUA payments, both scheduled and unscheduled, may not exceed the PUA payment limits shown on the policy data pages. That's what we looked at initially with the $44,000 and change. However, additional information here. Here's the big thing to be aware of. So it talks about the maximum PUA payments that can be made, which are the limitations. And a lot of times companies have a dollar cap too. They don't want us exceeding $2 million. Plus the amount of any target face amount associated with any 1-year term insurance target face amount rider under this policy. So what does that mean? Well, what that means is if you're throwing funds into PUAs and that goes into cash value, what does it also do? From the insurance company's perspective, it raises your whole life death benefit, which if you don't have a term rider, think of it this way. You own the life insurance company. I throw $100,000 into a PUA rider payment. That goes into cash value. It also gets me another $300,000 in life insurance. Let's say I do that when I'm 60 years old and I'm 30 when I start the policy. Are you concerned about that? A lot of insurance companies will be. We're on the hook all of a sudden for another $300,000 in life insurance. This term rider removes, or I should say reduces the liability for the insurance company. When you throw any amount of money into PUAs, your net death benefit will stay the same. I'm going to show you the 10x limits in a second here. But just to hit on this point, because this is very valuable, just insight to see how insurance companies view PUAs here. Scroll down. Here's the illustration we looked at. Remember this guy? You're throwing $50,000 per year into a policy. As you're doing that, your whole life insurance death benefit is increasing. Day 0 was up here, $1.48 million. However, as you add funds into PUAs, what happens to that whole life death benefit? It goes up. As it goes up, here's how a 1-year term rider works. Check that out, a face amount of 1-year term, that's the target additional death benefit. It goes down. By the amount the whole life goes up, the term comes down proportionately, leaving you, in this case, a $1.45 million. Interesting. So when a 1-year term rider is attached, the insurance company is not as concerned with you making large PUA payments that exceed their standard limits, because if you die before or after making that PUA payment, they're on the hook for the same death benefit. In this illustration, $1.45 million. Back to the contract there. So the contract, what that means when it says plus the amount of any target face amount associated with the policy, it's referring to that 1-year term rider. We see it there with any 1-year term insurance. But does it state 10x? It does not. Where do you obtain that information? Here's an older illustration document, which I wasn't even going to show, but it does show what the company has allowed for a long time. So for whole life policies, maximum illustrated PUA payment with dividend option Q. Option Q is that 1-year term rider. Here you go. Maximum illustrated PUA payments for policy years 2 onward. And this is again, when you have a 1-year term rider attached, lesser of 10x the base premium or $500,000 per year. Meaning you can exceed the standard limitations. Now, let's look at something that's a little bit more clear here. Much better. So here we go. PUA riders. What do we see here? Everyone gets the lesser of 3x the base premium. So if you have a $5,000 base premium, that would be another $15,000 per year, or $500K per year. So it's the maximum or the lesser of those two, as it says, the lesser of. Now, here we go. So you've got the first year excess, where you can go up to 50 times the base premium, or 10 million. However, let's scroll down here. So years 2 through 10, there it is, the same thing. Let's look at years 11 onward. What do you notice here? The lesser of 1x the base premium, or $500K per year in PUAs. So it looks like those restrictions do exist, unless we go to page 2. Details and exceptions. Did you know there are exceptions to the game? Or exceptions to the rules? Dividend option Q, which is the 1-year term rider. When that is attached, what do we see here? On policies with dividend option Q or R, which will keep the death benefit level, payments totaling up to the lesser of 10x the annual non-rated base premium, or $500,000, can be illustrated and paid at any time during the year. Not just illustrated and paid, specifying in writing from the life insurance company here. And that is until the face amount of 1-year term is 0. At that point in time, we default back to the ordinary limits. What I will add is with Guardian, if you've got a scheduled PUA payment, year 11 onward, we saw 1x. If it's scheduled, we have been able to illustrate that 3x the base premium in PUAs on an annual basis if it is scheduled. But if you have a 1-year term rider, extremely flexible, we can pour excess funds into the policy at discretion, which is nice. So a lot of good information here. Main thing is just to be aware of the limits that are offered by insurance companies. Let me know if this helps and if you have any questions. If you do have questions, please feel free to leave them in the comments below. You can also, or I would also ask if you enjoyed this, please hit the like button and subscribe for more, and we'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.